Hi everyone, my name is Emily Powell. I serve as the Director of Marketing and Business Development here at the firm, and welcome to the SGK Wealth Compass, where financial insights are easily explained. Today it is currently Friday, February 6th, and in today's weekly update, we will hear from John Steigerwald and Eric Randolph. Thank you so much, and we hope you enjoy.
Good morning, everyone. My name is John Steigerwald. I'm CEO of SGK Wealth Advisors.
And I'm Eric Randolph, Portfolio Manager and Certified Financial Planner.
One thing we love at SGK, amongst many things, is dividends. Talk to us about dividends today, Eric.
Absolutely. This is actually one of the areas that I think a lot of investors kind of miss out on, something that's really crucial overall in their portfolio. Dividends provide a lot of benefits, but let me talk about two of them specifically. Number one, especially in days like we had recently, the last 48 hours, with lots of volatility, companies that actually pay a dividend, their stocks will move along with the market, but it moves with a whole lot less volatility. So it almost acts as somewhat of a shock absorber when you actually have dividend payers in your portfolio. The other real big benefit, honestly, is inflation protection. It's not just that these companies pay a dividend and they pay the same amount every year. They actually increase the dividend. So, for example, in your portfolio, if you invest with us here at SGK, you have quite a few companies in your portfolio that actually pay a dividend. And the dividend increase last year, 2025, averaged somewhere between 10 and 11%, okay? Well, if you compare that versus inflation, let's say, is really at 2.7, but say it was 3%, that 10% increase, okay, is actually a multiple of what you have with inflation. That's what you call real inflation protection.
Yeah, outstanding. We had a leg down yesterday in the market, and I noticed that the big dividend payers in insurance, healthcare, like core holdings like J&J and Travelers, ended up in the green yesterday. In fact, last year, the facts are we had 37 companies in the portfolio raise their dividend, and the average dividend increase was 10.7%, roughly about 3 times the rate of inflation.
That's exactly it. We have a whole lot of stuff to get into today. So want to start off with some economic information. I know ISM numbers came out this week. Anything important there?
Yeah, we were pleasantly surprised. We had strong numbers both on the manufacturing sector and the services sector. The Institute of Supply Management releases gauges on the U.S. economy on a monthly basis. So these figures were for the month of January. Manufacturing was an outstanding number. It came in at 52.6, and that was an increase from 47.9 the prior month. A number above 50 signals expansion. So clearly there's replenishment of inventories going on, but that is a healthy sign for the U.S. economy.
I'll take it.
Yeah, the gauge of new orders increased by 10 points. We haven't seen that in a while. The services sector number was strong again. It matched the highest number since October of 2024, and it came in specifically at 53.8. And that's back-to-back months at that level. Services account for approximately 90% of the U.S. economy. So that's still a strong sector. Right. Now, it wasn't all a rosy picture this week. And we saw a lot of gyration, not only in stocks this week, but in bonds and interest rates as well. And a lot of that was driven by labor market data. So, Eric, can you talk to that?
Yeah, I wish I had better news, actually. So I kind of feel like Groundhog Day here, okay? We're waiting for winter to end, but not quite so soon. So unfortunately, private sector job growth numbers actually came in, slowed sharply. 22,000 net new jobs during the month of January. Hiring remains stagnant. We actually had some gains in education and health services. Professional and business services, unfortunately, still shedding jobs. Large businesses actually saw payroll declines. Okay, so at the end of the day, what impact does this actually have? What this may mean is that this may reinforce the Fed's view that wage pressure is actually easing. The only upshot that we can really gain from that is that it may mean that it gives the Fed some leeway to cut rates in the future. Yeah, and that's about the only good point there.
In fact, we saw interest rates drop across the entire yield curve. The spread between 2 and 10 years widened. It's at high levels. Short-term Treasury rates dropped more than longer-term rates. That was part of it. So how does that benefit our clients specifically in their portfolio?
So here's something that a lot of investors will probably miss, is that because of the inverse relationship in bonds, okay, of interest rates versus price, when the interest rates begin to fall, it means that the price of the bonds, especially, again, high-quality bonds in your portfolio, the price actually goes up. So it actually acts as somewhat of a buffer, especially during times like we had over the last 48 hours.
Nice. By the way, I love the Groundhog Day reference. I love that movie. You do not look anything like Bill Murray. I'm just saying.
Oh, that said, we also had a whole bunch of companies in the portfolio that actually reported. So what stood out for you this week?
Yeah, let's hit some highlights. Alphabet was a stock we added early last year for clients. Had a stellar year last year. Stock-wise, the tech sector's been a bit of a train wreck this year, but their numbers were strong. Now, initially, after the close, the stock traded down about 7%. And that was because they announced that they're going to spend about $185 billion, which is about $65 billion more than the market expected on AI-related investments. So that was a bit of a headline shock to traders. But throughout the day yesterday, even though the market was down, it slowly climbed back. And I think as analysts and traders digested the information in the earnings report, it was actually very, very impressive. So they exceeded analyst estimates for revenues, coming in close to $98 billion. Their earnings per share jumped 31% year over year, and again was about 20 cents better than analysts had forecast. We love the company because it's very diverse. It make money in a lot of different ways. Advertising is a big part of it through their search engine. YouTube advertising. YouTube is very popular, especially with the young generation. But Gemini, too, is paying dividends. Do you want to talk about?
As a matter of fact, I believe they have a deal that they struck with Apple. So with Apple Intelligence, they're actually going to be using or utilizing Gemini, if I got that correct.
Yeah, and that's their artificial intelligence. I use it all the time when I either on Safari or Google Chrome, Gemini pops up, and it's an incredible tool. Have you ever taken a riderless
I have not
taxi?
done that just yet.
Waymo.
Looking forward.
Well, I was at the Schwab conference in San Francisco, and I took a bunch of Waymo rides because we were looking at the stock at the time.
How was it?
It was incredible. I felt like it was a better driver than most other drivers on the road. I mean, it did drop me a block and a half from my hotel one time, so it's not perfect technology yet. But a little known fact, so Alphabet's the primary principal owner of Waymo, and they just did a funding round for $16 billion, which would value that company at $126 billion. And again, this is just one component of Alphabet, and a fair-sized company all by itself.
Absolutely.
How about McKesson this week, though?
So much needed positive news actually out of the healthcare sector. Strong third quarter results. We're talking top line. Revenues beat. Sales rose 11%, exceeding expectations. Also profits. We're talking bottom line. So we're talking $9.59 per share. This is up from $6.95 per share year over year. Is again beating expectations. Why, you might ask? This is on higher prescription volumes and then also increased distributions on oncology and multi-specialty products. Basically, also take a look at the guidance going forward. The company raised its earnings per share guidance going forward. How did the market react? We saw that the stock jumped 15% or over 15% on the news. So
yeah, that's a big move. That's a big company. It's been in the core for a number of years now, and really, really like it. They have a technology division too that was part of our thesis for investing in the company. I like the results from Ventus this week. This is another company that kind of flies under the radar. They're a REIT, which is a real estate investment trust, which is basically a publicly traded real estate company. They specialize in senior living facilities and doctors' offices. So we added it post-pandemic, late 2020. We were looking at it, starting adding into portfolios early 2021. The whole REIT sector, the pandemic, really hit that sector hard. So we felt it was a really good opportunity. Their numbers were really strong. It's measured by funds from operations per share versus earnings per share. Just that's the way the REIT sector rolls. But they came in with strong numbers that beat expectations, coming in at 88 cents for the quarter. Their revenues for the quarter were $1.57 billion, which was a 21% increase year over year.
I'll take it.
Yeah, they announced a dividend increase as well. Currently, it's at 2.2%, which is almost 2 times the broader market. And the CEO, Deborah Cafaro, had some very strong comments in the earnings call, which we participated in.
Wow. So I think that about wraps it up for what we have for you this week. Again, want to say thank you for all of you who spent your time with us today. Hope you have a fantastic weekend. And as we say here at SGK, cheers.